Robinhood looks like a company built for one generation of investors. But as those investors get older and wealthier, is Robinhood becoming the kind of financial company another generation has already learned to rely on? When I started digging into Robinhood's fundamentals, I kept coming back to Charles Schwab. Schwab started as a disruptive brokerage, then spent decades becoming a much broader financial company. Robinhood may be trying to do something very similar, only a lot faster. And that raises the question I want to answer in this video. Can Robinhood grow up with its customers? Because if it can, the company people still associate with trading, options, and crypto could eventually look a whole lot different than the Robinhood they think they know today. If you followed Robinhood for any length of time, you probably know the basic story. Robinhood launched with a simple idea: let people buy and sell stocks without paying a commission. Now, that doesn't sound revolutionary today, but back then, paying $5, $7, even $10 every time you bought or sold stock was normal. But Robinhood got rid of that, and it made investing really easy to access from a phone. That combination appealed especially well to younger investors, and it worked. Robinhood went from basically nothing to millions of funded accounts in just a few years. Then came 2020 and 2021. Interest rates were near zero. Stocks were moving, crypto was exploding, and eventually came the meme stock craze. Robinhood was right in the middle of it, but there was a weakness in that business model. Robinhood made a lot more money when its customers were actively doing something: trading stocks, trading options, buying and selling crypto. Then 2022 happened. Stocks fell, crypto collapsed, and a lot of that excitement disappeared. Robinhood's transaction-based revenue fell from about $1.4 billion in 2021 to $814 million in 2022. That's a drop of roughly 42% assets on the platform. It fell substantially. Monthly active users declined, and Robinhood lost just over $1 billion that year. Management also realized the cost structure that they had built during the boom was too big for the business that they had once trading activity cooled off. So Robinhood cut aggressively. 2 major restructuring rounds: lower staffing, lower marketing, office closures. Operating expenses came down substantially from 2021. But Robinhood still had roughly $2.37 billion of operating expenses against only $1.36 billion of revenue in 2022. And that's what I think 2022 exposed. You can build a very successful trading platform by giving people reasons to trade. But if you want to build a durable financial company, you also need to find ways to make money when they don't. And that's where I think the Robinhood story gets a lot more interesting. Because while a lot of people still associate Robinhood mainly with trading, options, and crypto, the company has spent the last several years building something designed to keep those customers as they get older, build more wealth, and need more from a financial company. So, is it working? Well, let's start with the customer. Robinhood's customer base has historically been young. At its 2024 Investor Day, Robinhood reported a median customer age of 35. About half its funded customers were millennials. Roughly another quarter were Gen Z. And that's important. Because think about your own financial life. The amount of money you had available to invest at 25 probably wasn't the same amount you had available at 35 or 45. Income changes. Retirement contributions can increase. You may have an old 401k to roll over. You may inherit money. And your existing investments have time to grow. So, if Robinhood acquired millions of people while they were young, the opportunity wasn't just to keep adding more customers. It was to keep the customers they already had as their financial lives got bigger. And Robinhood's own numbers show evidence that those customer relationships are getting larger. At its 2024 Investor Day, Robinhood showed the number of customers with more than $100,000 on the platform going from about 85,000 in 2022 to about 194,000 in 2023 to 321,000 by October 2024. Almost 4 times as many in roughly 2 years. And look at net deposits. about $17 billion in 2023, more than $50 billion in 2024, and $68.1 billion in 2025. By the second quarter of 2026, Robinhood reported $75.7 billion of net deposits over the previous 12 months. Now, I want to be careful with what these numbers actually mean. Robinhood's definition of net deposits include cash deposits and asset transfers from customers, along with certain other inflows, net withdrawals, and other outflows. So we can't look at these numbers and say all of that was new savings from existing customers who simply got older and started earning more money. So some of it's from transfers from other firms, some of it's coming from newer customers, and acquisitions also affect some of Robinhood's broader asset numbers. But Robinhood has also published customer cohort data showing that customers generally continue adding net deposits as their relationship with Robinhood gets older. Newer groups of customers have also started with larger deposits. And Robinhood reported at its 2024 Investor Day that customer retention has improved from roughly 80% several years ago to about 95%. So I think we can make a narrower and much more defensible conclusion here that Robinhood's customer relationships are getting larger. And if you already acquired somebody when they were young, you don't necessarily have to keep paying to acquire that same customer again. You just need to give them a reason to stay. And that's where I think Robinhood Gold gets interesting. Gold costs $5 a month or $50 if you pay annually. By the second quarter of 2026, Robinhood reported 4.8 million Gold subscribers, about 17% of funded customers. And Robinhood's latest comparison is important because it changed from the figures the company reported a couple years ago. As of the second quarter of 2026, Robinhood said the average Gold subscriber had 4.2 times the assets under custody of its average funded customer, about 1.1 times the net deposit growth rate, and about 3.1 times the retirement adoption rate. Now, that still doesn't prove Gold caused those customers to become more valuable. Somebody with more money may simply have more reason to sign up for Gold in the first place. But Robinhood has also built incentives into Gold that give customers reason to deepen that relationship. The IRA match is a good example. Gold members can currently receive 3% match on eligible annual contributions to self-directed Robinhood IRAs. Let's say somebody contributes $5,000. Well, 3% is $150. If they're paying $50 a year for Gold, that one benefit could already be worth more than the annual membership costs. But there's a catch. The customer has to stay subscribed to Gold for at least 1 year after receiving that first Gold match to keep the full Gold match. And the assets that earn the match generally have to stay in the Robinhood IRA for at least 5 years to avoid a potential early match removal fee. That's where I stopped looking at this as just a promotion. Robinhood isn't simply giving somebody $150. It's creating an economic reason for that customer to keep retirement assets at Robinhood. That's a retention incentive, and it creates a switching cost. If that customer contributes again next year, there's another contribution and another match tied to Robinhood's rules. Meanwhile, that same customer may start using more of Robinhood. And this is where we need to update the old picture of the company because several of these products aren't theoretical anymore. Robinhood Strategies is already a managed investing service. By the second quarter of 2026, Robinhood had strategies. It says their strategies had more than 300,000 funded customers and nearly $2 billion in assets under management. Robinhood has also moved into human financial advice. It acquired Trade PMR, which provides custody and technology to independent registered investment advisors, RIAs. In plain English, those are independent financial advisory firms that manage money and provide advice to customers. But then in June 2026, Robinhood launched the Robinhood Advisor Network. That allows eligible Robinhood customers to connect with independent fiduciary advisors who use trade PMR. Robinhood itself described this as a way to keep customers whose finances become more complicated as their lives change. Trade PMR's platform had grown to roughly $50 billion in assets by mid-2026. So Robinhood banking is also no longer just an idea, and there's an important distinction here. Now, Robinhood itself isn't a bank. Robinhood banking services are provided by Coastal Community Bank. But by the end of the second quarter of 2026, Robinhood said banking had more than $3 billion in deposits from more than 240,000 funded customers, with about 40% signed up with direct deposit. Robinhood Retirement had also grown to about $34.5 billion in assets by the end of the quarter. So the ecosystem is already becoming much broader. A customer can have self-directed investments, retirement accounts, managed investment through strategy, access to independent financial advisors through Advisor Network, a gold card, and banking services. That's why this reminds me a little bit of Apple. Apple didn't stop you from buying an Android phone, but once you use an iPhone, Apple Watch, AirPods, iCloud, Apple Pay, and other Apple services, switching becomes a bigger decision. The products reinforce each other. Robinhood appears to be trying to build a financial services version of that. And that's not just my interpretation. Robinhood itself talks about wallet share, a flywheel, and becoming more central to its customers' financial lives. But there's still a major hole in that ecosystem: employer-sponsored retirement. For a lot of Americans, that means the 401k. Think about somebody who starts using Robinhood in their 20s. They've got a brokerage account, maybe an IRA, maybe gold, maybe Robinhood banking, maybe strategies or an advisor through the Advisor Network. But every payday, part of their paycheck may still be going somewhere else, into a 401k administered by Fidelity, Schwab, or another provider. And over 20 or 30 years, that may become the largest investment account that they own. It also creates a relationship between Robinhood's customers and one of Robinhood's competitors. And Robinhood appears to recognize the broader gap. At its 2024 Investor Day, the company specifically listed employer-sponsored accounts as an area of future white space. Now, Robinhood didn't say we're launching a 401k. It hasn't announced that. But employer-sponsored accounts are on management's own list of areas where the platform could expand. Now, our analysis is that the 401k is the obvious major example. So, how could Robinhood eventually fill that hole? Well, they could build it, they could partner with somebody, or they could buy a company that already specializes in workplace retirement. Now, I want to be very clear here. Robinhood has not announced that it's going to buy a 401k company. That's just my thinking. But Robinhood has shown that it's willing to acquire capabilities when buying them may be faster than building them. Trade PMR accelerated its move into an independent advisor business. Bitstamp accelerated its international and institutional crypto capabilities. So acquiring specialized infrastructure wouldn't be out of character. The bigger challenge may actually be distribution. Even if Robinhood bought a workplace retirement platform, it would still have to persuade employers and benefit decision makers to choose Robinhood over firms that have been doing this for decades. That's a very different sales problem than getting a 25-year-old to download an app. But Robinhood does have financial flexibility. At the end of the first quarter of 2026, Robinhood had about $5 billion in cash and cash equivalents. Then in June, it raised $2.2 billion through 0% convertible senior notes. Robinhood described this as a great capital raise that increased its strategic flexibility for things like future growth and potential acquisitions. About $290 million of the proceeds went towards share repurchases. By the end of the second quarter, after the financing and Robinhood's other cash movements, cash and cash equivalents stood at about $5.4 billion. That's the number I think matters. Now, I'm not adding the $2.2 billion on top of the earlier $5 billion and pretending Robinhood had more than $7 billion sitting in cash, because it didn't. The point is simply that Robinhood already had substantial liquidity, then found a way to raise long-term capital at a 0% stated interest rate and increase its strategic flexibility. Again, there's no evidence that money was raised for a workplace retirement acquisition. But the 401k gap doesn't look like a problem Robinhood lacks the financial resources to address. And if Robinhood eventually does fill it, the customer relationship could become extremely broad. Banking, workplace retirement, IRA, brokerage, credit, managed investing, and access to financial advice. At that point, Robinhood isn't really just your brokerage anymore. It's trying to become a financial hub. And if all this sounds pretty positive for Robinhood, this is where we need to turn the argument around. Because Robinhood's products have changed dramatically, its revenue economics haven't changed nearly as much. In 2025, Robinhood generated about $4.47 billion in revenue. About $2.63 billion was transaction-based. That's almost 59% of the company. Options alone generated about $1.12 billion. Crypto generated about $901 million. And predictions market have become another rapidly growing source of activity-driven revenue. In the second quarter of 2026 alone, event contracts generated $156 million in revenue, up more than 10 times from a year earlier. Different products, but options, crypto, equities, future, and predictions market share something important. Robinhood generally benefits when customers are actively doing something: trading, buying, selling, speculating, making predictions. That's why I think we need to separate two ideas: product diversification and economic diversification. Robinhood has made enormous progress on the first. The second isn't nearly as far along. Another roughly $1.51 billion of 2025 revenue came from net interest. That's about 34% of total revenue. That revenue doesn't require customers to trade every day, but it's got different sensitivities: interest rates, customer cash balances, margin borrowing. Put transaction revenue and net interest together, and you're looking at about 93% of Robinhood's 2025 revenue. That's our calculation using Robinhood's reported revenue categories. Meanwhile, gold subscriptions, advisory, managed assets, and other recurring relationships are still a much smaller contribution to revenue. So the company has changed faster than its income statements. From the customer's perspective, Robinhood is becoming a broad financial platform. Economically, a lot of Robinhood still depends on people trading, borrowing, holding cash, and staying financially engaged. And that brings us back to Charles Schwab. Today, Schwab looks completely different economically. In 2025, Schwab generated about $23.9 billion in net revenue. Roughly 49% of that came from net interest, about 27% from asset management and administration fee, and roughly 16% came from trading. A Schwab customer can do absolutely nothing from a trading standpoint, and Schwab may still make money from that relationship. But Schwab didn't always look like today's Schwab. It started as a disruptive discount broker. Trading and commissions once played a much larger role. Then Schwab spent decades building around those brokerage customers: retirement, asset management, banking, advice, administration, wealth management. I think that wealth management was bought just a few years ago. Anyway, and gradually trading stopped defining the economics of the company. So Schwab isn't proof that Robinhood's gonna succeed, but it does prove that a transaction-heavy brokerage can evolve into something much broader. And it gives us a very simple metric to watch. Today, roughly 59% of Robinhood's 2025 revenue came from transactions. Now, suppose years from now, that's 50%, then 40%, then 30%. And at the same time, Robinhood's total revenues keep growing. That wouldn't mean the trading business failed. It would mean the rest of Robinhood grew faster. That's a transition we're looking for. But there's another test. What happens when markets aren't strong and customers aren't excited about trading? Well, we've already seen one version of that, 2022. In 2022, Robinhood generated roughly $1.36 billion in revenue. Operating expenses were about $2.37 billion. Management then aggressively reset the cost structure. Now, fast forward to 2025. Operating expenses were about $2.3 billion, almost exactly where they were in 2022. But revenue was no longer $1.36 billion. It was nearly $4.5 billion. Now, I don't want to give the impression that Robinhood somehow tripled revenue while expenses magically stayed flat, because that's not what happened. Management first had to cut the bloated cost structure that they had built during the boom. But once that was reset, Robinhood built a much larger business on roughly the same 2025 expense base. That's operating leverage. But there's another correction we need to make here. That $2.38 billion in Robinhood's 2025 operating expense number, it isn't a promise that Robinhood's expense base will stay there. In fact, by the second quarter of 2026, operating expenses were running higher as Robinhood invested in growth, absorbed its acquisitions, and recorded restructuring charges. So when I stress test Robinhood, I'm not going to pretend that 2025 expense number is a guaranteed future cost structure. What the stress test can tell us is something narrower. Today's Robinhood has a much larger revenue base than it had in 2022. For example, in 2022, transaction revenue fell by about 42%. If we apply that same percentage decline to Robinhood's 2025 transaction revenue, Robinhood would lose roughly $1.1 billion in revenue. Holding the other 2025 revenue categories unchanged, just for the exercise, would leave total revenue around $3.4 billion. That's not a forecast, and it doesn't prove Robinhood could earn a profit in a future downturn. It simply shows how much larger the revenue cushion is than it was in 2022. Now let's make it harsher. Suppose transaction revenue fell 50% and net interest revenue fell 30%. Again, holding the smaller 2025 revenue categories roughly unchanged just for the exercise. Revenue would come out around $2.7 billion. Still, that's not a forecast. And I'm not comparing that number to the 2025 expense base and declaring Robinhood recession-proof. A real recession could bring higher credit losses, lower margin balances, customer withdrawals, different marketing spending, higher or lower operating expenses, and changes in interest rates. But the exercise does show that Robinhood entering the next downturn has a much larger business supporting it than the company that entered 2022. And today's Robinhood also has risks the old Robinhood didn't have at today's scale. Credit's one of them. The Gold Card gives Robinhood exposure to consumer credit. Robinhood's total provision for credit losses rose from $76 million in 2024 to $114 million in 2025. And I want to be precise here too. That's Robinhood's total provision for credit losses across its credit exposures. It isn't the same thing as saying the credit card itself lost $114 million. But as Robinhood becomes a broader financial company, credit risk is going to matter more. So the new Robinhood may be less vulnerable to one type of risk while taking on another. And that really captures the transformation. The old Robinhood was simpler. It depended heavily on people trading. The new Robinhood may be more durable, but it's also much more complicated. Banking, credit, retirement, advisory, crypto, international markets, prediction markets. Different businesses, different risks. So the better question isn't simply whether Robinhood can survive another bear market. It's this: how much money can Robinhood make when its customers aren't excited about trading? Because that's when we'll find out whether this transformation is actually working. And even if Robinhood gets all this right, Fidelity and Schwab can see what it's doing. Fidelity already has most of the pieces Robinhood wants: brokerage, IRAs, 401ks, cash management, credit, advice, wealth management, crypto. Schwab has many of the same capabilities and keeps adding features aimed at newer generations of investors. So I don't think Robinhood's ecosystem itself is some kind of moat that nobody can copy. An IRA incentive can be copied. A card can be copied. A better app can be built. But there's something Fidelity and Schwab can't copy nearly as quickly: the relationships Robinhood already has with millions of younger customers. Robinhood didn't wait until those customers had hundreds of thousands of dollars. It acquired many of them when they were just getting started. By the second quarter of 2026, Robinhood reported 28.4 million funded customers and $369 million, no, that's billion, $369 billion in total platform assets. Fidelity can build another app. Schwab can offer another incentive, but neither company can go back 10 years and become the first investing platform somebody started using at 22. That relationship has value, and Robinhood also moves very quickly. Retirement, credit cards, banking, managed investing, human advisor access, futures, prediction markets, international expansion. That product speed can help Robinhood deepen customer relationships before competitors can pull them away. But switching costs work both ways. Somebody who already has a Fidelity 401k, IRA, brokerage account, cash account, and financial advice may have very little reason to move everything to Robinhood. So Robinhood doesn't have to beat Fidelity and Schwab at every product. It needs to give the customers it already has enough reason not to leave. And that's going to be harder as these customers get wealthier. A 25-year-old with $8,000 invested may care mostly about simplicity and low costs. A 45-year-old with several $100,000 may start asking about taxes, workplace retirement, estate planning, trust, fixed income, and more complex advice. Robinhood reached millions of those customers first. Fidelity and Schwab already know how to serve them when they're already wealthy. That's the race. Who controls the relationship as the customer's financial life gets more complicated? And I think that gives us enough to put Robinhood into a SWOT analysis. And let's keep this SWOT analysis simple. Strengths first. Robinhood has a large, young customer base. Those customers' relationships, they're getting larger. Net deposits are strong. Gold gives Robinhood a mechanism to deepen those relationships. The company has already expanded into managed investing, banking, retirement, and access to human advisors. And management has demonstrated strong product development speed and significant operating leverage. The weaknesses? Well, Robinhood is still heavily dependent on transaction and investment revenue. Employer-sponsored retirement remains a major ecosystem gap. Interest rate sensitivity matters, and the company is becoming increasingly complicated to operate. The opportunities? Well, the biggest may simply be growing up with its customers that they've already retained. It doesn't necessarily need another 28 million customers. It needs a larger share of the financial lives of the customers they already have. Workplace retirement could strengthen that ecosystem. Managed investing and advice could become a larger revenue stream that don't depend on customers they constantly trading. And the generational transfer of wealth could move significant assets towards the same generations that already make up much of Robinhood's customer base. Now the threats. Regulation. Competition from Fidelity, Schwab, and others. Trading in crypto cycles. Interest rate cycles. Credit risk. And execution risk. Because the faster Robinhood expands into newer financial businesses, the more important compliance, underwriting, technology, and risk controls become. And when you look at that SWOT analysis, something stands out. A lot of Robinhood's biggest strengths are connected directly to its biggest risks. Its customers are young. That's a strength. But those customers are going to need more as they get older. Robinhood moves quickly. That's a strength. But moving quickly in financial services creates risk. Robinhood keeps adding businesses. That creates diversification. It also creates complexity. Which brings us back to the question from the beginning. Robinhood looks like a company built for one generation of investors. But as those investors get older and wealthier, can Robinhood become the kind of financial company another generation already learned to rely on? After going through the fundamentals, I think there's a legitimate evidence that Robinhood is moving in that direction. Robinhood reported 28.4 million funded customers at the end of the second quarter of 2026. Total platform assets were $369 billion. Gold had reached 4.8 million subscribers. Retirement assets were $34.5 billion. Strategies had more than 300,000 funded customers and nearly $2 billion under management. Banking had more than $3 billion in deposits. And the advisory network now gives eligible customers access to independent human advisors. Those are real pieces of the broader financial relationship Robinhood said it wants to build. Financially, the company is also much stronger than it was just a few years ago. Management corrected the cost structure after 2022. The company is profitable, and it's got substantial liquidity. But the transformation isn't finished, not even close. Almost 59% of 2025 revenue still came from transactions. About 93% came from transactions and net interest combined. Employer-sponsored retirement remains a major gap. Competitors have enormous resources. Regulation matters. And the broader Robinhood becomes, the more complicated the company becomes to operate. So, if I were evaluating Robinhood, the business, over the next 5 or 10 years, here's what I'd watch. Not the stock price, net deposits. Whether customers keep moving larger balances onto the platform, gold adoption, retirement assets, strategies and advisor adoption, banking and direct deposits, and maybe most importantly, where Robinhood's revenue comes from. Today, transactions still represent almost 60% of the 2025 revenue mix. If that percentage gradually falls while total revenue keeps growing, that could be evidence that Robinhood is successfully making the kind of transition Schwab made decades ago. But if Robinhood adds all these products and its economics still rise and fall mainly with trading activity, then the ecosystem may not be as transformative as it looks. So, can Robinhood grow up with its customers? I think the evidence says it has a legitimate opportunity to do exactly that. But the next real test probably won't come while markets are strong and customers are excited about trading. It's going to come when they're not. Because that's when we'll find out whether Robinhood actually became a diversified financial company or simply became a much bigger trading platform.